This is Retire Ready, where we break down retirement planning and make it easy to understand so you can live your golden years to the fullest. If you're tired of feeling overwhelmed by retirement planning or unsure about where to start, you've come to the right place. Planning your retirement starts now with your host, Kyle Hammerschmidt, founder of Mocan Wealth, and co-host, Colin Hayes.
What is going on, everyone? Welcome to the Retire Ready podcast. My name is Colin. I'm here with Kyle. Kyle, how you doing today?
Doing good. Just trying to recover a little bit from a little hiatus vacation down at Rosemary Beach. Went down there for about 4 days. Worked a little bit, but it was mostly a vacation, so good to be back. Excited to kind of touch base again on what we discussed last week on the podcast, but kind of just going into more detail. Like I said, I'm ready to roll if you're ready.
Yeah. So like Kyle just alluded to, the last episode, which if you haven't checked it out, we go over the 6 steps to a tax-efficient retirement plan. And in the following episodes, we're going to go through each of those steps a little bit more in depth individually. So in today's episode, we're going to talk about step number 1, which is provisional income. Provisional income is a figure that is calculated based on a few different inputs, which we'll talk about today. But that number is used to determine whether a portion of your Social Security benefits are taxable. So there's actually 4 components that go into provisional income that you calculate to find what that number is. So Kyle, I'll let Kyle explain what those components are.
Yeah, so provisional income, we're really just talking about taxes on that Social Security benefit, just kind of some easy calculations here to figure out how much of your Social Security could potentially be taxable based upon the laws that haven't changed since the late 80s. So if you're not aware, Social Security was tax-free for a portion of time. President Reagan, basically, they passed some laws. They lowered federal tax rates in exchange to start taxing Social Security. And really around that same time is when the employer benefit landscape started to change, where they basically started offering the traditional 401k plans, and they kind of got away from the pension options within the plan. So I always tell people, like, your retirement taxes have been shaped for you kind of since the mid to late 80s. But let's kind of recap. So provisional income, just to make it as simple as possible, is like non-taxable interest. So if you kind of just want to do some math here, like how much, this is an annual amount, so how much income are you going to show on your tax return when you're taking your Social Security, and from the sources that would be non-taxable interest. So the perfect example here would be maybe like a muni bond. Getting a muni bond interest, yes, it's tax-free, but the amount, you would want to put an annual amount for taxable interest kind of in your little box there. If you're watching on video, you would just put an annual amount. For most of you listening or watching, you're going to put 0. You don't have any muni bond or non-taxable interest. And then the next category would be under provisional income, would be what's probably the most popular, the biggest bulk for most of you is going to be that ordinary income. At the end of the day, it's going to say, what sources of income do you have coming in when you're on your Social Security that are going to be taxed at ordinary income rates? So a couple of examples of this could be if you're going to work and earn income and be on your Social Security, okay? Again, there's rules to all that, which we'll do a future podcast on. But that in general could potentially make your Social Security more taxable. So if you're going to work and claim your Social Security, what's that annual amount of income you're going to be bringing in? Some other sources to look out for, which again, the majority of your savings are in these types of accounts, is your 401ks and your IRAs and your rollover IRAs and your ESOPs, 403bs, TSPs, even like pension income. How much on an annual basis are you going to be pulling from those types of accounts that would eat up some of your provisional income? Like an example would be, maybe you have $1 million sitting in your 401k and you had some number in your head that you're going to take out like $50,000 a year. Again, that would be your ordinary income number. It would be $50,000 that would show up on your tax return. The third category you want to look out for is the dividends and capital gains. Again, we're talking about inside of a brokerage account Are you going to have qualified dividends and capital gains that will be coming in on an annual basis? Again, the only what we're talking about is from a brokerage account, a taxable brokerage account. It's a TOD single, it's some type of joint account or a trust account, and it's going to show up. There's dividends and capital gains showing up on your tax return. If there's an annual amount, you would write that down. And then the very last one is half of the household Social Security benefit. Again, it depends on if you're single or married. So a single person's doing some math here and saying, okay, like let's figure out how much of my Social Security I might be giving back and how much is going to be taxable. So if you're going to take your Social Security at 65, it's going to pay you $30,000 a year. You would put in $15,000. If you're married and you're going to delay it, and maybe when you're both claiming it, it's $70,000, you would write in $35,000. Next part is you're basically going to add all that up, and it's going to say, all right, what do you have? And that's going to determine like how much of your provisional income. So if you're married, filing jointly, I'm assuming most of you did some math, and you're like, well, we're over $44,000. I'm looking at this table here, and it looks like there's nothing I can do. If you're over $44,000, it's saying up to 85% of your Social Security could be subject to taxes. If you're single and you did some math, and your number's over $34,000, it's saying 85% of your Social Security could be taxable. One thing to take away from this table here that hasn't changed in 30 plus years is that at least 15% of your Social Security is always tax-free. Now, depending on how you start manipulating and doing tax strategies and withdrawal strategies, which is, there's more to it. But if you just look at this, that's basically how you're going to calculate your provisional income on an ongoing basis. And I always tell people the number you came up with when you take your Social Security for provisional income is probably going to be the lowest it would be. But the key to a great Social Security and retirement strategy or retirement plan is figuring out how you can manipulate this provisional income while you're manipulating your tax rates and your tax codes and your withdrawal rates to keep more of your Social Security. That's the name of the game.
Yeah. And for those that are listening to this episode, if you're listening on audio, there's a lot of graphics that we're showing on screen here as we talk through this. So down in the show notes, there'll be a link to check out these PDFs to see exactly what we're talking about, like the graph that Kyle just mentioned about, if you're filing married, filing jointly, if you're single, how your different provisional income amounts would change the amount of Social Security benefits that are subject to tax. So what we're going to do now is kind of walk through an example of a real life example of provisional income with John and Jane, and kind of how in real life your provisional income would affect your Social Security.
Yeah, so this is like real life situations. Obviously for compliance purposes, I'm going to do some rounding and change some names. But the first example I want to give you is basically this traditional strategy. I call it traditional because most people, these pre-retirees and baby boomers, are going to kind of follow the herd. A majority of their money is in tax-deferred accounts that like never been taxed. They're just kicking the bucket down the road, and they don't really understand how this is going to tie into their Social Security strategies and how much taxes they're going to pay over their lifetime. So let's do an example. I have John and Jane Hopeful. They're married, filing jointly, and they're over age 65. And we're using the 2024 tax law. Let's just assume here they got about $60,000 of Social Security income, somewhere around down to $60,000. And then next they have about $50,000 of traditional IRA income coming in each year. So if you just do that math, the traditional strategy basically means this. You have two sources of income, Social Security, and then everything else you're going to be bringing in retirement is going to be subject to federal tax rates as they are at that time. So again, we're talking 2024, but what happens when tax rates or laws change in 2026 and that the 22 is now the 25% bracket, or if tax rates go up further in the future and down in the future. So again, the traditional strategy is basically saying you're going to have one or two Social Security checks. Everything else is taxed at ordinary income rates. Pensions, IRAs, 403Bs, whatever you're pulling in is subject to federal tax rates. If you do some math, it's about $110,000 of just like gross income that they're going to be bringing in. The question is, how much of that are they keeping? But if you kind of do their math on their provisional income, you're going to take half of the Social Security, which is $30,000, everything else they don't have non-taxable interest, they don't have qualified dividends, so now it's ordinary income. Well, now you got $50,000 here of IRA distribution, so their provisional income's $80,000. So now let's kind of dive into the weeds a little bit further. So if we examine and do some tax planning and throw this into their 1040, do an estimated tax return, their total income over 65 is going to be $86,600. You take into effect that standard deduction, which is $32,300. Their taxable income comes down to $54,300, and they're in the 12% federal bracket. So again, I'm recapping back to 8 to 10 years of conversations I've had, 8 to 10 years of running hundreds of plans. And the one thing I always get, and people have been told forever, and what I hear is, well, I'm going to be paying less taxes in retirement than when I was working. And I go, you are 100% correct. The example I just gave you for this married couple, when they retire, or if this is their situation, they're in the 12% bracket, paying less taxes on that income versus when they were retired and they were in the 22% bracket. The question you have to ask yourself is this the best way for the next 30 years to keep that tax bill as low as possible, keep more Social Security, and keep more of your shares invested? That's the question you have to be able to answer. And I can tell you from most plans that I've ran that this will end up being the highest tax bill of all the other ways of doing it. I kind of want to bring up some additional planning details. They have about $25,000 of room before they would kind of bump up to the next effective tax rate. If you're on Medicare, you have to understand Medicare breakpoints and premium breakpoints. They have about $104,000 of income before they would start paying increases on their monthly Medicare, and $25,000 before they'd start paying increases on their capital gains if they did have those types of accounts. So that's just question number one. Colin, you want to kind of go over that the pop quiz question?
Yeah, I'll ask you, Kyle. I know you know the answer, but you can be the answer here. So, question for everyone here: if you take $1,000 from a traditional IRA, or $1,000 from Social Security, 1,000 from traditional IRA, 1,000 from Social Security, which of those is worth more money?
Yeah, that's a big question I always ask people, is because a lot of people's strategy could be like, hey, this is what I'm dead set on. I am going to take my Social Security as soon as possible and delay touching my IRAs and 401ks as long as possible. And I go, that's a great idea if you can make it work. But the idea is, what's worth more to spend just in general? If you remember that table I just showed you, just remember, 15% of your Social Security is always tax-free. Every dollar you take from your IRA or 401k is 100% taxable at your federal tax rate. So what's worth more to spend is your Social Security. So it might be wise to kind of spend some time, run some numbers to figure out how can you keep more of that Social Security, and it allows you to keep more of your IRAs. But from a spending perspective, Social Security is worth more dollar for dollar, for sure.
Yeah. And now, we just went over, an example of John and Jane Hopeful, where they're using the traditional route of, Social Security and traditional IRA distributions, and we saw that their provisional income in the example was $80,000. However, had they been maybe doing some tax planning and some, future outlooks, there's maybe a different way to go about it. So in example number 2, we're going to talk about Jane and John Hopeful, but maybe a different route that they could take.
Yeah, so let's say John and Jane Hopeful, they invested some time to going through some strategies. They understood that there's not just one way to do it. Let's basically do some stuff here where we're kind of removing our minority shareholder, which is Uncle Sam, and kind of just legally paying the least amount of taxes as possible. And really what we're looking at is we're kind of going against the grain and not doing the traditional strategy, which meant like John and Jane Hopeful, they're married filing jointly over age 65. But let's say they did some stuff to where when they got to this point, so let's just say, okay, maybe they waited 2 years to touch their Social Security, so now it's worth $70,000 per year. During those years or prior, they were doing Roth conversions. Maybe they started saying, hey, maybe it does make sense to start paying some taxes up front because my Roth income won't make my Social Security more taxable. And we don't want to be showing too much IRA distributions on our tax return because we understand it's kind of tied into everything as far as like capital gains taxes and Social Security taxes and my average tax rates and marginal tax rates. We want to be kind of just better prepared. So if taxes go up, we can kind of switch and pivot. If taxes go down, we can pivot. If we ever need extra income, if there's a loss of life. So here's an example. They got $70,000 of Social Security, $10,000 of IRA distributions, and then their Roth portfolio is going to be able to provide them $30,000 per year in retirement. So their total income is around $110,000. Now their provisional income is at $45,000. We're going to take half of the Social Security, which is $35,000, plus anything taxed at ordinary income rates, which is $10,000. Again, there's two sources of income that are not part of that provisional income calculation. It's cash value life insurance withdrawals or Roth IRA income. You already paid the taxes up front. So we got $45,000 of provisional income. But now we have to kind of go look at, okay, what does your tax return look like now? Because we know how much of our Social Security could be taxable. So your taxable income on the tax return is going to show up at $16,850. You're going to take that standard deduction of $32,300. Their taxable income is at zero, and they're in a 0% federal bracket. So that's kind of just, it's legal. At the end of the day, what this household did is they were proactive, and they understood to get to something like this, they had to pay extra tax upfront to move money from their traditional IRAs to their Roth IRA. So maybe what they did is they were filling up their 24% bracket for 6 years. So they raised their tax bracket for 6 years. In exchange, at 69, they were in the 0% bracket for the rest of their life. Again, it shouldn't be everybody's goal to get to that 0% bracket. This is just an example. But the key is, like, how can you lower your average tax rate, keep more of your Social Security? I always say if you're keeping more of your Social Security, you just need less from your portfolio, so your money doesn't have to work as hard in retirement. So those are just a couple of items to consider when you're looking at provisional income. And then some additional planning examples would be like they have about $8,000 of room before they would kind of start taking on some tax hits. So they could potentially spend about $8,000 more before their effective tax rates would change. So those are two good examples. Again, these are just broad-based, like 30,000-foot view. I like kind of just going over these two extremes because it kind of opens the floodgates a little bit here on like what people could be doing. And again, most people are doing that traditional claiming strategy and withdrawal strategy. And it's not like it's a bad thing. It's just basically saying, like, are you okay with the pros and cons of making these types of assumptions versus being over here on the tax efficient side of like keeping more of your Social Security, paying less in taxes potentially, keeping more shares invested, spending more of your money. So those are just two big examples that kind of like, now you got to go run your numbers and basically say like, which of these is for us? How do we, if we want to do the tax efficient strategies, how do we get there? Like, what is it painful for us to get to that point? Does it make any sense? So those are some things you have to kind of walk through.
Yeah. And then in next episode, what we're going to talk about is categorizing your money by tax impact, just a little teaser of what's to come. But today, like Kyle said, we went over provisional income, what it is, how it works, and how the different routes of, provisional income can affect your Social Security tax. Kyle, anything else?
Nope. I'm looking forward to next week. Again, do your homework, run some numbers, and I think you'd be kind of surprised on just kind of what some proactive investing of your time might do for you. So,
awesome. Well, thanks everyone for listening and watching, and we'll see you in the next episode.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. The word retirement shouldn't scare you. Our passion is to be here to help you navigate every step of the way. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon. But in the meantime, for more education and information, hit up retirereadyacademy.org. And if you're ready to start your retirement planning today, go to our website at mocanwealth.com. Mocan Wealth Management is a registered investment advisor with the state of Kansas and Missouri and may only transact business with residents of those states or residents of other states where otherwise legally permitted, subject to exemption or exclusion from registration requirements. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services.